In this recording, we're going to look at IAS 10 focused on events after the reporting period. So to date, in terms of financial statements, we've always considered financial statements for a certain period of time, usually for a year. So you have the financial statements year ending 31st December, and anything that happens within that period is included in the financial statements. But I suppose you do have a more practical consideration then. Well, what happens once the financial statements are finished? So what happens in the 1st of January or the 15th of January 2020? If we're looking at the 2019 financial statements. So there is a certain period of time between when the financial period finishes and when the actual financial statements are issued, because there's a preparation time and auditing time, etc. And really, regard should be given to all information. So if something happens after the year end, we have to have some rules about, well, does that mean we need to adjust the 2019 financial statements? Or does that mean we don't adjust, but we need to disclose that information in the notes of the accounts? So if we didn't have clear rules, some companies would do one thing, they'd adjust the financial statements, other companies might just disclose, other companies might ignore it completely and leave it until the 2020 financial statements. So IAS 10 defines these rules and they figure out what is an adjusting event and what is a non-adjusting event. Right? So financial statements are typically prepared for a year. And they should be published as soon as possible after year end. But inevitably there's going to be a delay because you're going to have to get all the information together. It's going to have to be checked. It's going to have to be audited. The financial statements are going to have to be prepared in draft. Then they're going to have to be updated. And finally, the published financial statements are going to have to be given out. And if you're a PLC, usually there's quite a tight time frame in terms of stock exchanges. They have requirements of when the information must be released. But if we take, for example, Glanbia and look at their timeline of the delay between the end of the financial year and when the financial statements are actually released and published. So you can see here, as you'll have done in your continuous assessment, they have a year end, 29th December 2018. So this is the previous year. Financial statements were approved and authorised for issue by the board on the 19th of February. So about a month and a half, 6 weeks. The auditor signed the report on the same date. The results were announced the next day because they have to be their listed company. They need to be released so the users can analyse the results and buy or sell the shares. And then the actual annual report, the full big glossy document, was published about 2 or 3 weeks later because when all the information is brought together. But the key point in IAS 10, what they're interested in is, what about things that happen between the 29th of December, or say the 30th, the day after, and the 19th of February? So before the financial statements are authorised and approved, but after the year end. There are certain things that events after the reporting period we need certain rules on. So we have to try and figure out then, what are these events? Are they adjusting events, in which case we need to account for them and adjust the financial statements, or are they non-adjusting events? Right, so do you adjust the financial statements? Should you disclose in the financial statements any significant events? So for example, on the 7th of January, if a big manufacturing facility burned down for Glanbia, is that including the 2019 financial statements? Because technically at the year end, that facility was still there. But 7 days later or 9 days later, it burned down. So we need some clear rules to make sure the users of financial statements aren't given a false picture. Because you are looking at it at a point in time in the statement of financial position, but you are reading those financial statements maybe 2 months later. So it's that intervening period that creates a bit of a problem and what IAS 10 tries to solve. So what are events after the reporting period? And again, you may be asked to give these definitions and you may be asked to discuss, well, what's the difference between an adjusting event in IAS 10 and a non-adjusting event? So events after the reporting period are events both favourable and unfavourable, so it's not one or the other, that occur, and this is important, the time frame, between the reporting date, so now this happened to be just the 29th of December for Glanbia, and the date when the financial statements are authorised for issue. If you look at any annual report, you'll see it, they'll tell you what date the financial statements are authorised for issue. So in our case in Glanbia, it's the 19th of February. So if anything happens after the 19th of February, once the financial statements are signed off, that falls into the 2020, in this case the 2019 financial statements. So the scope of IAS 10 only deals with after the year end and before the financial statements are authorised for issue. And you have two different types of events then. Adjusting events, which are important, as the name suggests, you will adjust for these. These events provide additional evidence of conditions that existed at the reporting date. Now that's important. They give evidence of conditions that already existed at the reporting date. So these are not new things. They're just giving you new information about something that was already there, and in which case you will make adjustment for. Or there are events that occur after the reporting period which bring into question the going concern. So going concern assumes that, it's linked closely to IAS1, it assumes that the company will operate as a going business concern for the next 12 months. If something happens there that calls that into question, then that's an adjusting event, and you'll have to adjust the financial statements on that basis. So that's a very fundamental thing. That's quite a big element that could have an impact on the company's financial statements. On the other hand, a non-adjusting event is something that happens after the reporting period, and the conditions did not exist at the reporting period date. So for example, that fire that happened on the 7th of January, so it's a fictitious one, that there was no conditions there at the 29th of December to say that that fire was ongoing. So that was a non-adjusting event. It happened after the reporting period, and it didn't relate to anything that was there at the 29th of December. So it will take a small bit of time to get used to the differences. But the one thing about IAS 10 is they give you plenty of examples, and that's what we'll work off in terms of exam questions as well. So if you know your examples and you understand the key principles, you should be well underway in terms of your knowledge of IAS 10. So to work through it then, for the treatment adjusting event, you post a journal entry, because again, that is giving you more information about something that was there at the financial statement date. So example of adjusting events would be, for example, the settlement of a court case. So this would be a good one. So for example, at the date of the financial statements, you would have an idea you're up for a court case, and you may have some potential liability. And we know from IAS 37, you would create a provision based on your best estimate. But if that court case is settled in the IAS 10 period, so for example towards the middle of January, and that figure is different than the provision, that is what we call an adjusting event, because the settlement amount, if you want to go back to the definition of an adjusting event, it gives additional evidence of conditions that existed at the reporting date. The legal case was there at the reporting date. That existed. This is giving us additional information. So the settlement of the court case means you would go back and update the provision at the year end for the settlement amount, because you know exactly what it is, and it happened before the financial statements were authorized for issue. So that will be an adjusting event. All right. Likewise, this is a tricky one, evidence of impairment of assets. So for example, if a trade receivable went bankrupt 2 or 3 weeks after the year end, that most likely meant that that company was in financial difficulty at the year end. So IAS 10 says you can use that as evidence to write down that trade receivable at the year end. So even though bankruptcy only happened after the year end, it gave us more evidence that this probably existed at the year end. Same with inventory. If you sell inventory at a lower price, i.e. it's been written down to its NRV after the year end, that gives us an indication it should have been written down at the year end date. So any of those information that happened after the year end, that gives us evidence that maybe those assets were overstated at the statement of financial position date, you can write them down. They are adjusting events. And you'll see some of those examples when you look at your question pack as well. So the bankruptcy of a trade receivable after the year end, the sale of inventory lower than cost after the year end, or the sale of an asset at lower than its cost at the year end. So that could be an impairment of an asset, an indicator of impairment. Other ones then, assets sold or purchased before the year end, but you only determine the price after the year end. So for example, you might sell it the last week of December, but you haven't really agreed a price. If the price is agreed after the year end, you can use that price then to update the financial statements. And likewise, certain things can't be agreed until the financial statements are finished. So profit sharing or bonus arrangements, which are based on profits, you can use that once you determine what the profits are to go back and to adjust the financial statements. So the key principles about all of those are the conditions existed at the financial statements date. Same one here with the discovery of fraud. If you discover fraud in January, well, that fraud was probably ongoing in the previous financial year. So you need to go back and update those financial statements because you've got further information that has come to light before the financial statements have been authorized for issue. So adjusting event it's new information, but it relates to something that was there at the financial statement date. In that case, you will have to post updating journals. So you update the figures. You either write off a bad debt, you write down your inventory, or for example, in this case, you account for the fraud and you'll put the expense through the P&L. So take one example here. So Anon prepares the financial statements 31st December, and at that date, it was owed 20,000 by a customer. The financial statements were approved for issue on the 25th of February. So what we're saying there is from the 1st of January 2020 to the 25th of February 2020, that is the period of IAS 10 scope. Anything that happens in there, you have to decide whether it's an adjusting event or it is a non-adjusting event. Anything that happens after the 25th of February is outside the scope of IAS 10, and that will just go into the financial statements next year, in the 2020 financial statements. So 10 days after the year end, the customer is declared bankrupt and it's expected that they will only be able to pay 15 cents in the euro. So what that means is 85% of the amount that's owed is going to be written off. So you're going to write off 85%. So what does that mean? So that means 10 days after the year end, customers declare bankrupt. So realistically, IAS 10 says that gives us an indication this customer was in financial difficulty at the year end. It's giving us additional information of a condition that was there at the year end, the 31st December. So this is an adjusting event, and it's an explicit example in IAS 10. And what you will do is you will write off the amount that you don't expect to get. Now be careful, you expect to get 15 cents in the euro. That means for every euro you're going to get 15 cents. So for 20,000 euro, you're going to receive 3,000 euro. So the bad debt, and that's where students get, you don't write off the 3,000, you write off the 17. So this would be adjusting event, and it's going to be debit, SOPL, bad debt, credit, trade receivable. And this will be done, be careful, 31st to 12th, in this case, 19. So you would do it at the year end, even though you only got the information 10 days later. That's how IAS 10 works. If it's an adjusting event, you go back and adjust the financial statements. So it's like the bad debt would have happened at the year end. So that's an important one to understand your key definitions. So that's an important one to look at. Now there's one little trick in this that I want you to highlight here because you'll see it in some exam questions. If you made further sales to flip on the 2nd of January 2020, so you made new sales just before they went bankrupt, which is not untypical because these things can happen quite quickly, they are not an adjusting event. Because remember, those sales would actually not be in the 2019 financial statements. So if you had made another 10,000 sales on the 2nd of January 2020, before it was declared bankrupt, those, 10,000 sales will be a non-adjusting event. So there'll be two separate ones. The 20,000 that was there at the year end will be one thing, that'll be adjusting, as you do it as we've done, and the other 10,000 will be separate. And that 10,000 will be written off the next year in terms of 2020 financial statement. So it's quite nuanced. An adjusting event is only related to conditions that existed at the year end. Any sales post year end does not fall into that remit. So that was an important one that is given examples in IAS 10 when you look them up. Non-adjusting event then is different. As the name suggests, you do not adjust, no journals. The only thing you have to do is disclose it. So you disclose the nature of the event, what happened, estimate the financial effect if you can, and where it's not possible, disclose why you cannot estimate it, because it may not be possible yet to put a figure on it. And again, IAS 10, to make it helpful, they give you examples. So decline on your market value of investments. So post year end, the market value goes down because there's a stock market crash. That is not a condition that existed at the year end. But what it is you'll have to disclose it. So the users of financial statements have a good idea. You acquire or dispose of a company after the year end, you have a major reconstruction, or any major issue of shares, or a debenture is another word for a loan, if you draw down a new loan. Likewise, if you buy or sell assets, if there's a fire after the year end, the example I gave of Glanbia, it's just a fictitious one, change in tax rates or changes in FX rates, which of course can impact international businesses. So all of these, if you try and understand conceptually the difference between adjusting and non-adjusting, all of these, nothing relates to at the year end. The acquisition that wasn't there at the year end happened after the year end. The restructuring, the major issue of shares, none of them relate to conditions that existed at the year end. So that's an important distinction to understand. To be able to explain a narrative, what are adjusting and non-adjusting, and also be able to do the calculations out as well. So let's have a look at this example, Walker Limited. So prepares financial statements to March, but financial statements are approved for issue in June. So from the 1st of April to the 10th of June, that's your IAS 10 window. And in that window, a hurricane damaged a number of motor vehicles that will cost $20,000 to repair or replace. And the profit was 1.2 million for the year end. Well, the first thing here is, this is a non-adjusting event. You have to be able to explain it in English as well, in narrative form. And reference IAS 10. The reason it's non-adjusting is, this doesn't give us information about a condition that existed on the 31st of March. This only happened for the first time ever new on the 18th of May, so it's non-adjusting. Now, one thing to watch for here is, for non-adjusting events, you only disclose if the impact is material. So this is a little more nuanced here. Require disclosure if material. Right, so that's an important one. And what we mean by material is it going to impact significantly on the user's financial statements interpretation of results? And here, the answer is no. 20,000 out of a profit of 1.2 million. It's not going to be material. Usually material is somewhere around 5%. So 1.2 million at 5%. You'd want to have an adjustment of somewhere around 60,000 to be considered material. So watch for that as a little nuance in these questions. It may be non-adjusting and you may be correct, but it may not require disclosure unless it is material. And one nice thing to get at practicality of that is, well, how do I know what materiality is for some of the real world businesses? They have to disclose this in their financial statements. So if you go to Glanbia on page 115, the auditor will show what materiality is. And you'll notice the auditor audits to materiality. They're not considered worried about every individual error. They're only worried about material errors. So for example here, the application of the auditor's concept of materiality for Glanbia, group profits 13 million, 5% of profit before tax, or 1% of equity. So there's different ways to define it. So they said profit before tax was 266, and they said materiality then is 13 million. So 13.1 divided by 266.8, it's in and around 5%, 4.9%. So the logic of that is, anything that is lower than 13 million of an error, they're not concerned about. But what they do is, any of those smaller errors, they aggregate them up together, and anything above 0.66, they report to audit committee. So it's not that they ignore everything, it's just that in terms of a material transaction, it must be about 5% of profits. So it's an important concept that you'll cover in auditing as well, and you'll see a lot when you start going to the real world. But that's applicable here. Unless the event is material, it will not be disclosed. It doesn't have to be disclosed. So you can if you want voluntarily, but it doesn't have to be. So keep an eye out for that as a little nuance in IAS 10 as well. So the answer there is, it's a non-adjusting event, but it does not need to be disclosed under IAS 10 because the 20,000 is much smaller than the 5% materiality threshold, which is the usual one that's used. So that covers then IAS 10, the two key things, adjusting event and a non-adjusting event after the reporting period. So you should be able to describe to me what is an event after the reporting period, what is the window in which those events are relevant, and what is the difference between an adjusting event, giving examples, and a non-adjusting event, giving examples. The other key thing that IAS 10 covers is dividends, how to account for them, and how to record them. So dividends here fall into three categories. Ones that are declared and paid in an accounting period, usually they're called interim dividends. So interim dividends that are declared and paid, sometimes they pay them halfway during the year. You can have interim dividends that are declared, which means they're approved by directors, right? They're approved by shareholders, but they're unpaid. So they're a liability at the year end. And then final dividends are usually agreed after the reporting period is finished, once they know how profitable the company was. But you can have dividends that are proposed, but are not declared, or if you want to put there, approved. So they haven't really been declared or approved yet. And how you account for each of those is slightly different. And all of that is coming from IAS 10. So it's important to understand these because they can easily be dropped in as part of a bigger exam question. So if dividends are declared and paid in the accounting period, so they're paid completely and approved within the financial year, well then you just recognize it. You debit your dividends, credit your bank. Debit dividends paid or retained earnings, credit bank, they'll go to the statement of changes in equity. But importantly, dividends declared after the reporting period are not recognized as a liability. So dividends declared and paid in the accounting period are fine. But if dividends are only declared after the year end, they are not recognized. They'll be recognized next year. What you'll usually only do there is disclose them. So there's an important distinction there. Declared and paid in the year, fine, recorded. Declared after the year, another word for declared can be approved, they fall into next year's accounts. So it's the interim dividends. If the interim dividend is declared but unpaid at the year end, they are a liability if the directors neither retain a right to cancel them. So the shareholders nor the directors, so they're proven they're going to be paid, but usually in most jurisdictions, directors retain this right. Right? So therefore it's not a liability. So the only situation where you can have unpaid dividends as a liability is if it cannot be cancelled. And if it cannot be cancelled, you will debit dividends and you will credit dividend payable as a current liability. So declared here means it's authorised and no longer at the discretion. So it's all declared means it's approved by shareholders and it's going to happen. If it's not declared, there's always the possibility or the potential that directors just cancel the dividend, in which case it's not actually a liability. So what you're looking for here is if a dividend has been proposed and it has been declared, meaning it has been approved, it will be a liability. If it hasn't been, it's not. It's just disclosed. And then final dividends are usually proposed, but they'll be subject to approval at the AGM, which is after the year end. So the annual general meeting usually happens when the annual report comes out. This is not a liability until it's approved. So in that case, that will just be disclosure. So you disclose in the financial statements, this dividend has been approved or has been proposed by the directors, but has not been approved yet. And when it's approved, it'll become a liability, which will be in the subsequent financial year. So there is a couple of tricky ones there to understand in terms of dividends. And what's a nice example here is, let's look at three different scenarios to think, well, how do we account for each one here? So let's take each one in turn. The first one is, date the dividend is proposed, 12th of November. It was approved on the 7th of December, and the reporting date is the 31st of December, and it was paid after the year end. Well, in this case, it was both proposed and approved before the year end. So that means this is a legitimate dividend. The trick is here, it's not credit bank though, because it's not paid until after the year end. So for scenario one, it will be, in this case, scenario one, it'll be debit dividends, or if you want to go directly debit retained earnings, that's fine as well, either or. And then you will credit dividend payable, which will be a current liability because it's going to be paid for 10 days after the year end. So because they are approved before the year end, it's fine. Slightly different scenario here now, still proposed during the year end, but not approved until after the year end. So that means here it has been proposed but not approved. And as we set up here, proposed but not approved, it's not a liability until the AGM of the company. You do not recognise, so you'll only disclose this. So at the 31st of December, there'll be no debits and credits because it's not a formal approved dividend yet. And even though the dividend was approved here, if it's not approved before the year end under IAS 10 for dividends, you only disclose it. So you'll disclose to say there's a dividend, it has been approved after the year end, and it's been paid on the 1st of February. But no adjustments will be made. The difference in scenario 3 then is it wasn't even proposed during the year end. So nothing happened during the year end. It all happened after the year end. In this case, there'll be no adjustment and there will be no disclosure. The reason being, nothing happened during the year end. It all happened after the year end. So that's a key thing to watch for IAS 10 and dividends is, if it's approved during the year end, you adjust for it. If it's only proposed during the year end, you disclose it. If nothing happened in the year end, nothing is done. No adjustment and no disclosure. So it's a slightly different variation, but dividends are quite important. That's why it's covered specifically as its own separate section in IAS 10 as well. So to give you 2 examples there, you can have a look at them in your own time. Glanbia, they look at a post-year acquisition. So I think I have Glanbia's one here. So we look at 180. Note 38. See if we can get it here. So events after the reporting period. So see note 15 for the final dividend recommended by directors. So you can see there to say that there's a post-year end dividend, but they just disclose it. And then also, subsequent to the year end on the 19th of February, which is the date of the financial statements authorised for issue, just in the IAS 10 window, they agreed to acquire 2 companies. And they just given information about what's going to happen. So again, this was the acquisition of a business post-year end. It's not an adjusting event. That's why it's in as a simple note at the back end. But look how small it is. Not even a half page. You're probably talking about 1/6 of a page there. With 1 paragraph. So unless you understand the annual report and the key standards, it's very easy to miss important things like that. But that's going to have a huge impact on the 2019 financial statements because it was acquired during that year. So again, it's important to understand the key importance of these standards, particularly in terms of disclosures. And you can have a look as well. Kerry Group talk about acquisition and dividends in their note 34. So the date of approval for the financial statements for issue, they are disclosed on the financial statements. So if you see page 127 of Glanbia, it'll tell you, hopefully the 19th of February. Did it say note there? Note 1, page 127. So board of directors, year end 21st December, and you're told here then, highlighted in yellow, the financial statements are approved and authorised for issue on the 19th of February. So about 6 weeks after the year end. But that has to be given in every set of financial statements. So the users of financial statements understand the gap between the year end and the date of financial statement approval. So that's mandated under IAS 1 and IAS 10. The last thing that's covered in IAS 10 then is the concept of a going concern. And this overlaps a lot with IAS 1 and has been quite topical in more recent times with the business failures of Carillion, Thomas Cook, etc. in the UK. Question marks around the reliability of going concern. That every company must assess the ability of the entity to continue for the next 12 months. And if information comes to light after the year end, that this company is going to be bankrupt, it's not going to continue, that's an adjusting event in IAS 10. And it's fundamental that you're going to have to restate your whole financial statements based on a breakup basis because it's not going to be a going concern. So IAS 10 and IAS 1 are linked clearly there. You must disclose whether or not the company is a going concern, and your auditors will be very focused on that. There's actually a whole auditing standard just on going concern as well. And if the company is not preparing financial statements on a going concern basis, there must be disclosure on the basis of that. Why, what has been done, and why is the entity not going to be a going concern. So it's quite an important one. As I said, given the more recent failures and the trouble the auditors are in now in terms of spotting going concern issues, it's going to be very much in focus from the regulator's perspective, from the company's perspective, and from the auditor's perspective going forward. Right, so disclosure then, we said non-adjusting events, you must disclose the nature of it and the financial impact. You must disclose when the financial statements were authorised for issue. We've seen that. And in terms of UK and Irish GAAP, they're very similar. So FRS 102 is the same treatment. There might be one or two small differences in terms of the disclosures of dividend, which are required in the international accounting standards that are not required in FRS 102. But said for all intents and purposes, they have the same treatment. Adjusting events, non-adjusting events, and the majority of the dividend treatments as well. So have a look again. It's in my recommended textbook will be the Darcy one, but I appreciate if you're at home, you may not be able to get access to that. So your question packs, 12 is fine. There will be a tutorial question on this, and your lecture slides are more than sufficient. And if you want extra reading, you can go into that hyperlink that gives you a summary of the standard in IAS Plus, as well as some nice practical examples. Right, so that looked at IAS 10 events after the reporting period.